Overconfidence. Smart people aren't exempt from professional here. Charlie is referring to the collapse of long-term capital management, which was a hedge fund set up by the famed Wall Street bond trader John Meriwether in the late 1990s. Meriwether brought together some of the smartest people from Wall Street and academia, including VADs in mathematics and economics, several of whom were Nobel laureates. Those brilliant minds devised strategies for investing in bonds and derivatives using tremendous amounts of leverage, which, if things went their way, would earn outrageous returns on their partners' invested capital. The problem with the strategy was that the potential for losses was catastrophic. Meriwether thought that the company could protect itself by using a trading strategy that employed bond spreads. It would measure the historical spread between very similar bonds, such as the yield spread between two-year Treasury bonds trading in January and March. If the spread between January and March Treasuries greatly decreased or increased in relation to its historical average, LTM would buy one and sell the other, betting that at some time in the future the spread would close back up, which it always did because they were essentially the same bond. LTM often made 1% or less on a trade. That might not seem like much, but multiply 1% by the $124 billion in capital it was working with, and it amounts to a profit of $1.24 billion. Do that a couple of times a year, and you start showing outrageous returns on investors' equity investments of $4.7 billion. In the second year of operation, Meriwether earned his investors a 43% return on their invested capital in LTM, and 41% the next year. Everything was going well until Russia surprised the world in 1998 by defaulting on its domestic debt, devaluing the ruble, and declaring a moratorium on payment to foreign creditors all in the same week. That caused the bond market to panic, and LTM spreads all went in the wrong direction, causing the company to show a massive loss. When that happened, the banks that had loaned LTM a total of $120 billion wanted either one, more collateral, or two, their money back, neither of which was forthcoming. Literally overnight, LTM became insolvent. The Federal Reserve Bank of New York went in and organized a group of Wall Street banks to take control of LTM, and its investors lost the majority of their money. Charlie's lesson here is that a combination of super smart people and large amounts of leverage often ends in disaster. I might add that the combination of really dumb people and large amounts of leverage usually ends in disaster as well.